Welcome to Inside India. I'm Jay Pyong, and here are your headlines. Indian markets set for a cautious start as traders look for progress on trade talks with the United States. Reports say New Delhi's top trade envoy could head to Washington again this week. Meantime, the U.S. and China enter a second day of talks today to break an impasse on their trade deal. Markets are hoping for a breakthrough as latest data shows China's economy continues to lag. The latest numbers on factory and output and retail sales all missing expectations. And Asian stocks are struggling for direction ahead of this week's Fed meeting. Market bets are almost fully priced for a 25 basis point cut in interest rates at the end of the central bank's meeting. Good morning, and a quick look at Asian markets before the start of this fresh new trading weekend. It's looking cautious yet defiant, it seems, for major indices that are open today. Keep in mind that markets in Japan and Malaysia are offline due to holidays in Kuala Lumpur and in Tokyo, respectively. But we're seeing some gains, that is, for the South Korean Kospi up by about 0.5%. Also defiant for the Shanghai Composite and the Hang Seng in Hong Kong, with gains there despite the fact that we did get August macro data from China that showed retail sales and industrial production all coming in well below market expectations. We're also seeing the Australian ASX 200 today open in the red by about 0.3%. The Indian market's also set to come online in about 45 minutes, and we want to take a look at what Gift Nifty futures are now forecasting before the opening bell. And keep in mind the Nifty is on 8 straight days of gains, and it seems based on where the level is now, 25,172, that would be about 60 points above where they closed actually back on Friday. In contrast, we're seeing the Indian rupee also finding a little bit of strength. 88.26 is where the local currency stands, but again, it is within touching distance of their weakest levels on record, which they achieved just a few weeks ago at about 88.33. So something to watch out for, but so far a firmer start, at least, to the Monday session for the local currency, the Indian rupee. And as we headline, the U.S. and China are meeting in Spain's capital of Madrid to iron out their trade differences. Elaine Yu is here with the details. Elaine,
hey JP, so these trade...
Go ahead.
Yes, just going to say that these trade talks are becoming more and more complicated, and analysts aren't expecting concrete deliverables here, really. And what's interesting is that TikTok was not officially on the agenda of these tariff talks until now. And both sides, the U.S. and Chinese government, have previously been careful to keep it off the table. But now the deadline for TikTok's divestment or ban is coming up on Wednesday. So it is something that the two sides have to address. And we were talking to Dan Wang from Eurasia Group earlier, and she said the best case scenario from these talks is really just extending both the TikTok and the trade truce deadline and working towards a meeting between President Xi and President Trump as well. But People's Daily, the Chinese Communist Party's official newspaper, has weighed in on TikTok and defended the company, saying that it has made positive contributions to employment and consumer spending in the U.S. and said TikTok's success reflects market dynamics and business innovation. And the paper also said that the Chinese government places high importance on data privacy and security, has never required data collection outside China in ways that violate local laws, and they blamed the U.S. for politicizing this issue. But the expectations are low with tensions running so high. And ahead of the trade talks, both sides also upped the pressure with these chip restrictions. The U.S. added 23 Chinese companies onto its entity list. 2 specifically were penalized for acquiring U.S. chip-making equipment for the Chinese chip maker SMIC. And in response, China's Commerce Ministry has launched an anti-dumping investigation into certain analog chips from the U.S. and also announced a separate anti-discrimination probe into U.S. measures against China's chip sector. But in this backdrop is also some pressure on Chinese policymakers, as we just saw the economic data from China coming out, missing estimates across the board. The numbers for retail sales and industrial output at 3.4% and a 5.2% growth year on year in August are the weakest reading earnings so far this year. And we spoke with Hui Shan of Goldman Sachs, the chief China economist there earlier today. And she said that these numbers do show the impact of higher tariffs here with weaker exports, especially those plunging exports to the U.S. will impact the industrial output number here. So they do have to keep this in mind as they move ahead with these trade talks with the U.S. JP.
Elaine, you with the latest with regards to the trade talks between the U.S. and China. At least the good news there is that both sides are talking and still are trying to get to some deal, whatever that might actually look like. Appreciate the insights and the updates, Elaine. The U.S. may also be talking trade with India this week, with officials from both sides expected to resume talks. New Delhi's chief negotiator possibly heading to Washington, D.C. But ahead of those discussions, U.S. Commerce Secretary Howard Lutnick is once again taking aim at India, criticizing the country for refusing to buy even small amounts of American corn. Asked if Washington is mishandling ties with key partners like China and India, Lutnick described the relationship with New Delhi as one-sided. Meantime, the U.S. Treasury is calling on G7 and EU partners to impose new tariffs on China and India, with an aim to curb their purchases on Russian oil. Washington says those sales are helping finance Moscow's war in Ukraine. A Treasury spokesperson told Reuters tariffs would be lifted once the conflict ends, and stressed that Europe must act if it wants to see peace restored. Meantime, trade talks between India and the European Union appear to be showing more progress. The bloc's trade commissioner was in New Delhi last week, describing negotiations as intense and moving with unprecedented momentum.
I'm very happy that I can also address you in the middle of what are very intensive talks and negotiations on what I believe would be ground-breaking free trade agreement between European Union and India. And we've been negotiating this for quite some time, but I can tell you that it never got to such a momentum as we have right now.
And India's Commerce Minister Piyush Goyal echoed that optimism, reaffirming that the commitment to a free trade agreement. He added that the search for a perfect deal should not stand in the way of getting an agreement finalized. Ashok Malik is a partner and chair of the India practice at the Asia Group. He joins us today to help us again keep track and make sense of all the latest developments in regard to India and the much needed trade and very important trade deals that they're trying to hammer out with partners across the globe. Ashok, thank you so much for joining us today. You heard from the Commerce Minister Piyush Goyal a while ago that a perfect deal shouldn't stand in the way of getting to an agreement with the European Union. Do you agree with the sentiment, sir?
Well, absolutely, because negotiating a full-fledged perfect deal that the Europeans are satisfied with and Indians are satisfied with could take us well into the next century. Both entities here, both India and the EU, realizing that they're living in a world where American tariffs and the American approach to trade has made life difficult for both entities, for both Europe and India, and both of them require new markets, new partners, new supply chain integration mechanisms, are recognizing that some deal is better than no deal, which is why there is optimism that some sort of an agreement could be hammered out as early as the end of this calendar year and put into motion and put into implementation early next year. Will it be the perfect deal, which will be the idealistic FTA that we would have hoped for in, say, the early 2000s? No, those FTAs no longer exist. We are looking at a workable deal, which will still be fairly substantial for both entities.
So you're confident that perhaps a trade deal can be inked between the two sides, India and the EU, by the end of 2025. But what might stand in the way of getting this deal across? Basically, what are some of those non-negotiables that might make it difficult to get to this deal, sir?
You know, agriculture remains an important issue in India, agriculture is a contested issue in any trade negotiation. Try negotiating with Japan and getting rice into Japan. Try negotiating with the Europeans on agriculture. Try negotiating with the Australians. So trade negotiations always falter at before the agriculture issue. That is the case with India too. Dairy, other sorts of imports from the EU will be contested. Automobiles is also an issue where India is concerned about the degree of European dependence on Chinese supply chains, given that India has a reasonable automobile ecosystem as well. These are two issues of concern. Labor standards could become a third issue, though I think the Europeans will need to be a little flexible on that, because otherwise that will stand in the way of a deal. Placing impossible standards which India at its level of development cannot adhere to will again be problematic. But most important, politically, both sides recognize that having a deal today is more important than not having one.
So a lot of this is actually being done, as we know, Ashok, to try and offset the potential tariffs that India is trying to get lowered from the United States, from Washington, D.C. And trade talks, they've indicated, could resume. But you have Congress people like Howard Lutnick, for instance, this time taking up the baton, taking up the bad cop role, if I may coin it as such, saying that the U.S.-India relationship is one-sided. How are you viewing these? Because some people are saying that the mixed messaging from the United States is a bit frustrating. But do you think this is just really a negotiating tactic that people are putting on the back of their minds while they continue these talks, and it's just an attempt by the United States to maintain a firm stance as these negotiations continue?
Before any negotiation, whether it's a trade negotiation or any other sort of negotiations, somebody on one side will play bad cop, will play the coercive, strong arm sort of person at the table, and which is what Howard Lutnick, as Commerce Secretary, is doing. But I have followed the India-US trade negotiations over the course of this year very closely. The two sides have reached substantial agreement on tranche 1A of the trade deal, which is largely goods and commodities. The digital services and the e-commerce and the digital trade negotiations have been pushed for later, which is really the trade of the future. India has placed an offer that, quite honestly, from the Indian position, is an unprecedented offer, offering much wider quotas and much deeper cuts to a vast universe of U.S. commodities and exportables. There are some concerns about certain agricultural commodities that will remain. However, I do believe both sides are attempting to find some sort of a halfway house, which is satisfactory. The U.S. is facing pressure from its soybean farmers because China has cancelled certain orders to the U.S. The U.S. is facing challenges from its sorghum farmers. It's facing challenges from its corn farmers. It's looking for new markets. India can provide some of these markets, but not all. GM food is a no-no in India, and that is an area we can't really progress on because GM food or GM produce for human consumption is not permissible in India, and it is a political hot potato. However, using GM crops for ethanol production, for instance, can be done, and I do believe that could form part of negotiation. Again, if you look at dairy, which is a big issue for America, India has a large dairy industry, which is peopled by small farmers who would be put out of business if big dairy from the US or the EU, for example, comes in with its volumes. And therefore, that, again, is something very difficult for the Indian government to accept. However, certain types of high-end cheese, which cater to a small urban market, could be permitted with appropriate duties. So I do believe much of the negotiation has already happened and been agreed to. Some bells and whistles need to be added. If the political mood in Washington is conciliatory, the deal can be done. The deal is not being stalled because of the inherent weaknesses of the deal that has been hammered out so far. It's been stalled because of the politics.
And I'm glad you brought up the political aspect of this, actually, Ashok, because it seems that there is a political tinge. We spoke to Mohan Kumar the other week, actually, talking about those non-negotiables, agriculture and auto workers in India. But again, this is also perhaps the basis of the industries that the U.S. is also trying to protect or trying to enhance. The American farmer, the American auto worker. Is this going to prove to be an impasse that will be difficult or near impossible for India and the United States to actually overcome or find a resolution to? You seem to believe it's not.
Not really, because if you the number of U.S. agriculture products that India can import, for example, certain types of fruit, nuts, even a feed for cattle, not for cattle, sorry, for poultry, which is in demand in India. And as long as it's not GM feed, it can find a market here. So that apart, there are a variety of American commodities, chemicals and commodities, which can find a ready market in India, and that has been part of the trade negotiation. And then there's energy. Energy is enormous. Energy is an enormous market in India, and this includes traditional energy and non-traditional energy. It includes LNG, it includes crude oil as soon as the US starts revving up its crude oil production. There's the whole nuclear industry, which is being spoken about as India makes legislative changes to allow the private sector into the nuclear industry. So there's an enormous basket of goods and commodities that can make for a very robust trade deal. It's not just about wheat and milk.
Okay, and I'm glad you brought up the energy aspect there, because that is an opportunity. It also is at the heart of one of the big contentions that the U.S. seems to have now with India most recently, and that's the purchase of some of these Russian crude oil imports. What's the possible scenario here? Is there a possibility where India actually starts to relax or find alternate supplies, or even fill that with U.S. energy imports? And how difficult or how simple is it to just swap things out without impacting, say, energy security in India?
Look, obviously, India, for its own needs, as well as for the excellent refineries India runs, which are amongst the best in the world and which contribute to global markets, would want to import crude oil from wherever possible, depending on market conditions and market prices. This includes the US. We've been buying crude oil from the US in previous years. And as soon as crude oil volumes from the US come up to requisite levels and exportable levels, I'm sure we'll do the same. When it comes to the oil purchase from Russia, this is completely legal and within the sanctions regime drawn up by the West, including the United States, in following the Russian invasion of Ukraine in 2022. If those rules are changed, India will adhere to the new rules. Those rules need to apply to all countries importing energy from Russia. That includes India, Turkey, China, which is the biggest importer, the EU. There are EU countries that import oil. There are lots of EU countries that import gas. The US itself has, till recently, imported uranium and palladium. So India is not the only country importing commodities or energy from Russia. The rules have to be the same for everyone. If the rules are changed, India will adhere to the new rules.
Yeah, and these rules, I mean, ideally, we would see fairness applied and the rules applied in a fair fashion. But there's still a lot of uncertainty with regards to tariffs, trade, impacting the Indian economy and the outlook, and all of these other things we brought up. Ashok, I'm just curious, what are you advising clients to do regarding investments in India while some of these uncertainties persist? And what are you hearing from them as well?
Well, obviously, clients at the Asia we talk to at the Asia Group are concerned because while India is not as much of an exporting country as some of its Asian peers, especially in Southeast Asia and in the ASEAN bloc, the point is for the industries affected by the 25% additional tariffs imposed by the United States, those tariffs could prove existential. That is textiles and garments, gems and jewelry. These are industries which are fisheries also. Because we export a lot of shrimps and prawns to the US. For these industries, these tariffs are going to be very, very difficult to manage. And yes, you can find new markets, you can pivot, but that will take some time. So countries are watching this with some companies are watching this with some caution. They would like to see signals of a reconciliation between the two countries, and the recent exchange of social media tweets and posts between Prime Minister Narendra Modi and President Donald Trump, leading to a reopening of the trade negotiations, has certainly given companies which have stakes in both India and the US, and many countries have enormous stakes in both, especially technology companies, has certainly given them some hope.
Ashok Malik from the Asia Group, we thank you so much for joining us today on Inside India and sharing your insights on the latest developments with regards to India and the trade negotiations and the trade deals they're trying to ink with various multiple partners on the global stage. Appreciate your thoughts, sir, and thank you for joining us today on the program. Well, more news and updates lined up on the other side of this break. Stay tuned. You're watching Inside India. Welcome back. You're watching Inside India, and here are some of the other stories we're keeping tabs on. Nepal has named former Chief Justice Sushila Karki as interim prime minister after anti-corruption protests forced the exit of KP Sharma Oli. Speaking in Kathmandu, Karki pledged that her cabinet will run for 6 months before handing power over to an elected government. She also added that her government is focused on service, not power.
The conditions under which I had to take responsibility, I am not here because I desire to do so. Voices on the street said, "Bring in Sushila Karki," and I was compelled to take charge. This is why I am working with my team, and we are not here to taste power. My age does not support that either. We were asked to join and take charge. We are here to serve the country, and we will only stay here for 6 months, not more than that.
And Indian Prime Minister Narendra Modi appealing for peace in the state of Manipur, where 2 years of ethnic violence has killed more than 260 people and displaced over 60,000. On his first visit to the state since the clashes erupted, Modi met with families and unveiled nearly $1 billion in development projects.
To bring life back on track in Manipur, Indian government is taking all possible measures. Our government is helping those who were rendered homeless by the violence by building 7,000 new houses. Recently, a special package worth $3.4 billion was accepted. To help the displaced, special provisions worth nearly $600 million have been made.
Meanwhile, the Philippines, Japan, and the United States are launching a joint exercise in the disputed South China Sea. The Philippine military confirmed the drills on Sunday, the same day China said it carried out routine patrols in the area. Beijing also warned Manila against what it called provocations, including bringing in external forces as backup. Let's move on to Japan now. A startup in the country is set to issue the first yen-pegged stablecoin. But what does this mean for the Japanese currency itself? Lin is here to explain. Well, Lin, what does it mean for the yen, and why is this such a big deal right now?
Right. I think it ultimately depends on what the demand for this yen stablecoin will be, keeping in mind some of the, I guess you could say, unique factors about Japan's market, the fact that more than 30% of the population is above the age of 65. So we're talking about pensioners, and versus other developed economies, Japan remarkably still relies quite heavily on cash as well. Now, what is going for this yen-denominated stablecoin, though, is that it is fully regulated, so it does have that legal backing. And in theory here, if it does take off, well, then it will mean that it's yen positive, right? And also JGB positive as well, because like what we've seen in the United States in terms of dollar-backed stable coins, it is 1-for-1 backed by safe and liquid assets, right? So we're talking about bank deposits, but, you know, in the US case, we talk about treasuries. Here, we're talking about Japanese government bonds. The Bank of America, though, have done some research on this. So this is a private startup here. It's called JPYC Inc., based on what they are hoping to do here, which is issue 1 trillion yen of yen-backed stablecoins over 3 years. And on the assumption as well, JP, that 80% of that will be backed by Japanese government bonds. It is still only a drop in the ocean when you compare it to Ministry of Finance issuance here, which sits at around 11 to 12 trillion yen per month. So I guess the short answer to the question here is that it won't make much of a difference right now, but certainly it's a trend to watch as we go forward, because when we think about the startup's goal here, they see this as really kind of changing the payment infrastructure, starting off with institutional investors, hedge funds, etc., these firms that are looking to move large sums of money, and then the second layer, which is getting that consumer buy-in, and that's going to be the key.
All right, and you're also saying it's going to impact yields.
Well, the thing is in theory, but it depends, of course, as I said, on how much of it will actually be taken up here by the public, right? And the research is showing that based off of JPYC Inc., this is the startup's goal here, it's going to make no impact, really. But if they can get more adoption beyond the institutions, then potentially it could. And, this is, of course, coming at a time when we've been really focused on JGB market and some of the tensions there as well.
Hence the question, really. But it's fascinating to see how stablecoins are now starting to make their impact felt slowly but surely, at least, in the country of Japan. Lynn, thank you so much for joining us and bringing us that very interesting update. Well, coming up, loads of macro data to chew on this week in India as we eye the Federal Reserve's meeting as well. We'll talk more about the Indian economy after the short break. Do stay tuned. Welcome back to Inside India. Let's take a quick check now of how the U.S. dollar is moving and shaking before the open in India itself. And we're seeing that the dollar index is looking a little bit firmer, but just by this much, really. 97.60 is where the index is against some of its major peers. Now, we're eyeing the big Fed meeting on Wednesday stateside, with markets almost fully pricing in a 0.25 percentage point cut in interest rates. We'll also get the summary of economic projections that could give more clarity on the Fed's outlook for growth and inflation. CNBC's Dominic Chu has a look ahead for all the events that we're watching out for this week in the United States.
The Federal Reserve begins a highly anticipated policy-setting meeting on Tuesday, with a decision on interest rates coming on Wednesday. The central bank is widely expected to make a cut for the first time since December of 2024. Social media app TikTok could go dark in the U.S. on Wednesday as it faces a deadline for the third time to find a new non-Chinese owner. The CDC will meet in the week ahead to review scientific data and make vaccine recommendations. The health agency's advisory committee is expected to discuss COVID-19 vaccines, as well as vaccines for hepatitis B, measles, mumps, rubella, and varicella, and RSV. Facebook and Instagram owner Meta Platforms will hold its annual developers conference in the week ahead, Meta Connect. The company is expected to unveil its newest software and hardware innovations and share its latest plans for artificial intelligence. And Apple's new thinner phone goes on sale, the iPhone Air, on Friday, along with the iPhone 17 and iPhone 17 Pro models, as well as the new Apple Watch Series 11 and the Apple AirPods Pro 3. I'm Dominic Chu. Get all your business news on CNBC.
And about 13 minutes before the Monday market open in India, let's take a final check of where Gift Nifty futures are sitting before this open today. And we're seeing that it is once again foreshadowing that we might be in for a ninth straight day of gains. 25,170 is where it sits right now, about 66 points above the Friday close. Meanwhile, a firmer Monday, that is, for the Indian rupee, strengthening against the greenback to about 88.23. India's retail inflation inched up to about 2.07%, that is in August, just shy of expectations of 2.1%. This was driven mainly by higher food prices. That's still comfortably within the Reserve Bank's 2 to 6% tolerance band. But markets are betting on further rate cuts from the RBI later this year as growth risks mount and the U.S. Federal Reserve signals easing as well. And later today, we'll get a read on Indian wholesale inflation for the month of August. A Reuters poll expects wholesale prices to rebound to 0.3% after slipping into negative territory back in July. Anubhuti Sahai is the head of India Economics Research at Standard Chartered Bank, and she's here to paint a clearer picture of what inflation is telling us regarding one of the world's largest economies and one of the world's fastest growing economies, that, of course, being India's. Anubhuti, thank you so much for joining us today. If I'm not mistaken, Standard Chartered's own estimates for inflation for that month was at about 2.3%, so slightly more significantly higher, that is, than the actual reading of about 2.07%. Did anything surprise you either positively or negatively with regards to the inflation read that we just got last Friday?
So, of course, there was a downside surprise versus our expectation, and it primarily came because we expected vegetable prices to rise by 6% on a month-on-month basis, but the pace of increase was a little slower at 4%, and that led to the downside surprise. Core inflation remains subdued, which was in line with expectation at around 4.1%. In fact, if you look at FYTD, core inflation has averaged just at 4.1%, and the uptick has been very, very gradual. And to that extent, it shows weak pricing power in the economy. Having said that, I think when we are looking at the August inflation number, we are not very focused on what the August print, where the August print came. It matters, but probably going forward, and especially for inflation prints beyond October, those will be watched out very, very carefully by the market to assess how the GST cuts are playing out in terms of inflation impact. And secondly, India has seen excess rainfall in many parts of the country, and if there is any adverse impact on food inflation. So these are the two dynamics which will be under watch going forward, despite a very subdued August inflation number.
Right. And as we mentioned earlier on, the print we're looking out for today is WPI or WPI inflation, or India's equivalent of producer prices. The expectations of the market right now are about 0.3%. What are Standard Chartered's expectations, and how important is this on your macro radar?
So WPI, we are slightly lower than consensus. We are looking at a WPI number of 0.2% versus a market expectation of 0.3%. The uptick is primarily coming because of an adverse base effect. We think food inflation will remain in contractionary territory, albeit not as not so much in deep red as it was in July. Core inflation is where we see an uptick coming up because of base effect. So we do think that it's likely to move up from 1.2 to 1.6%, and that is likely to pull up the WPI number. Having said that, WPI has remained extremely subdued over the past several months, and that is one of the most important reasons why we are seeing a very, very low deflator. This is important because when we are looking at India's GDP, the deflator has a very high share of WPI. And given that WPI over the course of the year is unlikely to be more than 1%, CPI is also likely to remain pretty subdued. A low deflator is, impinging on very low nominal GDP growth, but a high real GDP growth. So WPI number also matters a lot, especially when we are looking at the GDP growth trajectory going forward.
So, Anupati, why are wholesale prices so subdued in India? Is there a reason why it's been that way? And is this a good or a bad thing, actually?
So it's good or bad in both. Depends on the perspective you're looking at. So if you look at the WPI, there are two main components. If I broadly, or three main components. One is food, and food inflation has been low because of good monsoon and very good production, and that's the reason why food inflation remains in contractionary territory. Second, and the most important part, is low global commodity prices. That is keeping, if you look at the WPI basket, bulk of it is, India is a major importer of commodity, and with subdued global commodity prices, it has kept core inflation extremely subdued, just closer to 1%. The third part, within global commodity prices, one price which matters a lot for India is the crude oil prices. And the crude oil prices have remained very subdued, $62, $63. And if you look at the fuel index, which has a high component of imported crude oil, that has been contracting for last 18 months. So, there are a whole host of factors. Domestic factors matter, but WPI has a larger share and it reflects the global commodity price dynamics more dynamically than CPI. And that is the reason why WPI has been low for such a long period.
Now, Anupati, while you're here, and since you mentioned fuel, I do want to pick your brain as to how important this is for India. And that's because one of the big sticking points that's emerged in recent weeks with regards to U.S.-India trade talks has been the purchase of Russian fuel, which has kept fuel prices and energy security in India somewhat anchored because of the lower discounts you're getting from Russia. In a scenario where Russian oil is suddenly removed from the menu for India and you have to shift to other oil sources and maybe even more expensive oil sources, what kind of impact will that have on inflation, basically? How sensitive is inflation in India to a change in oil prices, especially if you're buying from a more expensive source?
In usual circumstances, a 10% increase in crude oil prices has a negative impact of close to, anywhere between 25 to 35 basis points on the headline CPI. Having said that, at this point in time, Indian consumers are already paying, a retail fuel price which is closer to $85. Thus, even if the global crude oil prices move higher, or if Russian oil is moved out, the impact on inflation trajectory will be very, very limited in our view. Probably the impact would be more on current account deficit and to some extent on fiscal balances. There is a very strong view in the market that Russian oil has saved India a significant amount of dollars. There has been saving, no doubt about it, but we don't think it is as large as the market perceives it to be. If today India shifts from Russian crude oil to, say, US, Russia is on the lower end, US is at the higher end, the current account deficit will just widen by $6 to $7 billion in our view, which is not a very, very large amount, given that India has a large trade, runs a large trade deficit of almost $20 to $25 billion on a monthly basis. There will be some fiscal revenue losses, but at the end of the day, our sense is that today the discount from Russian oil is limited. So even if there is a shift, the impact should be more muted. The bigger impact would come if the global crude oil prices move rather than India just switching away from Russian oil to some other source of crude oil imports.
So how difficult does this mean that it would be simple for India to just wean itself off of Russian crude because of the limited discount and the limited impact of the discounts right now? Or are there other difficulties that we'll have to account for, such as, say, shipping them from other places or, say, the switching, for instance, of this oil?
So, in terms of shipping, if we all just go back, go a little back in time, till 2022, India was not importing anything from Russia in terms of crude oil. And therefore, if there are any news sources, I'm sure the industry will find its way. It might take a little bit of a time, but it will, they will be able to figure it out pretty quickly. Even in terms of refining capability, when India started thinking about importing Russian oil, the refining capacity was considered inadequate to go and refine a heavier crude oil import from Russia. But again, the industry is able to adapt. So it shouldn't be too much of a problem. Here, whether India moves away from Russian oil to any other source would very crucially depend on the trade negotiation and India's view of how its sovereignty is getting impacted, because there is a lot of pressure from US, and probably those are the more important factors in the equation rather than just the cost. Cost, in our view, is the cost impact would be very limited in our view.
Right. So you said that the cost impact would be limited, but it would have it might make a bit of a dent on the current account deficit, fiscal balances in India. How would that, say, affect, in this scenario, how would that affect, say, the potential for credit rating improvements in India? We did note that S&P, for instance, upgraded their view on India's credit rating just a couple of weeks ago. But could that be limited if we start to see perhaps current account deficits eroded just by a little bit, should that scenario play out?
So current account deficit is very, very well contained. Even in the worst case scenario, if oil prices say move up to $85, and I'm talking about global crude oil prices, even in that kind of a scenario, the current account deficit is likely to remain well contained at less than 1% of GDP. So risks from current account deficit are limited in our view. We are more focused on how, one, the portfolio investment flows into the country plays out. They have been very muted. And secondly, because of the ongoing trade fragmentation and the ongoing tariff negotiations, etc., there is a fair bit of uncertainty on the supply chain relocations. So to that extent, the focus will be on how capital inflows will play out, especially the portfolio investments and foreign direct investment. These have been very important, sources of funding the current account deficit. So while current account deficit remains very, very well contained at less than 1% of GDP, uncertainty on capital flows is something which is likely to be a key player in terms of deciding the direction of rupee. So for instance, if we take an adverse view, then probably the overall balance of payment can actually switch into a double-digit deficit if the capital inflows are very, very muted and the current account deficit, say, widens to 1% of GDP. In a more positive scenario, if current account deficit is closer to 0.5% of GDP, which is our baseline view, and there is a little bit, not massively, of some bit of capital inflows, then the current account deficit can be in a single-digit to $10 billion kind of a balance of payment surplus. So it's current account deficit is not an issue. Funding of current account deficit in today's uncertain global environment, in our view, is a much bigger issue which needs to be watched out. But probably from a 12 to 18 months perspective, the RBI has more than 10 months of import cover. So external sector, despite slowing capital inflows, are still very, very resilient.
Right. So I do want to ask you more about trade and the rupee later on, Anubhuti, but I do want to go towards the RBI's decision, because as you outlined, the fiscal deficit, the current account deficit seemed to be very well contained, fiscal balance pretty robust, inflation quite benign. It seems that there's room for them to actually cut. Is that the expectation? And do you know why the RBI has been a bit more cautious, despite the fact that they seem to have a lot of room and a lot of reasons to actually loosen monetary policy a little bit?
At this point in time, our forecast is that inflation will remain extremely benign. So even till Feb of 2026, inflation is likely to remain below 4%. And the average for this financial year would be close to 2.6. Next year would be 4.3%. And the core inflation, which is extremely important, is likely to remain anchored around 4%. Now, if you look at the inflation trajectory, it clearly opens up room, in our view, of 25 basis points. Now, our forecast of inflation at 2.6% this year and 4.3% this year assumes GST rate cuts been passed on to the economy, but only half of it, not 100% of GST rate cuts passed on to the economy. If 100% of GST rate cuts are passed on to the economy, or say 70-80%, then the inflation profile can look far more favorable than what we are forecasting as of now. So clearly, it will focus on the inflation trajectory. It does seem that there is a room for 25 to 50 basis points of rate cut. Having said that, we are not expecting any more rate cuts from the India MPC. And the reasons are, one, the MPC has already front-loaded its rate action between Feb and June. They have really delivered, between Feb and August, they have delivered much more than what the market was expecting, 100 basis points of rate cut. They have infused massive amounts of liquidity, announced liquidity-enhancing measures in advance. Therefore, the need to deliver more is not needed. The other part is that we are only talking about rate reduction, or a possible room for rate reduction of 25 to 50 basis points. After that, the real rates can come under pressure, and India is a savers economy. So RBI will have to balance that out. And all said and done, if there is room only for 25 to 50 basis points, probably RBI needs to save that ammunition in case if something more dramatic comes from the global environment. So whether you look at it from a future risk management perspective, or even from the bond market perspective, for bond market, the last rate cut never matters. After that, the yields always start moving higher. So our sense is, while there is room, if there is a need, RBI can cut. But is it something which we are expecting in our baseline profile? Answer is no, not now, as of now.
Okay. Now, you mentioned the risks and uncertainties and making sure they have ammunition should those arise. And one of them, of course, is the possibility of lower exports because of the U.S. tariffs. Is there a view from Standard Chartered's research on exports perhaps going down because of these U.S. tariffs? And what might your forecast be with regards to an impact on exports should that come to pass?
So right now, India is facing 50% tariff on its exports to US. And overall, close to $50 billion of Indian exports are exposed to these high tariffs. At 50%, it is absolutely unviable to export to the US. Having said that, the manufacturers we have spoken to are trying to figure out ways take some losses on their books. The government is also providing, there is work in progress to provide some export support package. And the recent GST cut is also likely to help a lot of exporters. One of the major exports from India to the US is textiles, and GST rates for a lot of textile related inputs have been reduced dramatically. So our sense is all these measures can help, but at 50% it becomes very unviable. So the worst case scenario is 100% drop, which we don't think will happen. But one can safely assume that there will be a large proportion of exports which might not play out in the from September to December onwards. One can assume, it's very difficult to say, but like 50-60% drop in exports to the US can happen if the increase in tariff has not been able to be borne by manufacturers, government, and the retailers from the US. So some hit will be there. Our baseline view is that this tariff remains till December. And after that, we do see it coming back towards 25%. So a lot would, if it is just
Right.
4 months, then it would be a $10 to $12 billion hit. But if it is for a longer period, then the hit will be much larger.
All right, that provides a lot of context with regards to the possible downside from these tariffs. Anubhuti Sahai from Standard Chartered Bank, thank you so much for your insights and appreciate you taking the time to join us today on Inside India. And Indian markets have joined the trading day. We'll look at some movers in Mumbai after just a short break. Back in 2 minutes. Well, Indian markets have been trading for about 9 minutes now, and don't look now, the Nifty 50 has opened in the red. Could this be the day where they snap 8 straight days of gains? Well, it remains to be seen. We've only been trading for about 8 minutes, but overall it is a sluggish start for the Indian equity benchmark. We're seeing the Indian rupee unchanged and flat at about 88.27 in today's session. Let's look at some of the movers in the Indian markets this morning. Tata Technologies is moving ahead with expansion plans in Europe after acquiring German automotive firm S-Tech for 75 million euros. Tata Tech CEO says the move will give it access to the S-Tech's advanced driver assistance systems. Tata Tech shares right now currently up by about 1.4%, just over 711 rupees apiece. Airport operator GMR Airports reporting a dip in passenger traffic last month. Overall, the group saw traffic drop 3.5% on year to nearly 9.3 million domestic traffic in the period was flat, but international traffic was up nearly 3%. And GMR Airport shares currently trading about 0.4% in the green, actually defying that sluggish open for the Nifty 50, but we'll see if that they can hold on to these meager gains as the session progresses. Adani Power has signed a 25-year agreement with Bihar State Power Generation Company to supply 2,400 megawatts of electricity from a new greenfield plant. The project is expected to generate up to 12,000 jobs during construction and another 3,000 once operations begin. Adani Power shares now up by about 2.2% at 661 rupees apiece. Meantime, India's markets regulator, SEBI, continues to relax rules. The regulator has now made investing easier for overseas and sovereign-backed funds by reducing paperwork and lowering compliance requirements. The relaxation comes as foreign outflows from Indian markets continue to surge. SEBI also eased requirements for IPOs to support the growing market, including allowing large companies to launch issuances with a smaller share. And a big sporting headline over the weekend. Indian cricket fans cheered as the country beat Pakistan in a tense Asia Cup clash. The match taking place under a cloud of tension. Some had been calling on India to boycott sporting ties with Pakistan following a terror attack in Kashmir back in April, which New Delhi linked to Islamabad. Indian captain Surya Kumar Yadav dedicated the win to the nation's armed forces and paid tribute to the victims of the attack, calling the victory a perfect return gift to India. Matches between the two sides always draw mega and massive viewership. And that's all the time we have today on Inside India. But do keep watching CNBC. Access Middle East is up next. Have a good morning.